Very good afternoon to everyone in India, and very good morning to everyone in Germany. So I was looking at the participants list, and there are quite a few people from Germany, some even Europe. So a very good morning to all of you. My name is Sumit Sharma, and I'm the Regional Director of the Indo-German Chamber of Commerce here in the Bangalore office. And I hope you all are doing well and you are safe, and so are your loved ones. So I hope everything is fine at your end. Let me start by thanking all of you for supporting the activities of the Indo-German Chamber of Commerce and also continuously joining all our webinars. So we really value the relationship. So our hearty thanks for that. And of course, since COVID started, we have been almost doing a webinar every week. So I think by now our events team has done more than 70 webinars, and I hope you all are able to join that. And a big shout out to our team in the events, basically Mira, Sana, Hani, and Monas. So probably you have been getting too many mails from them. So very sorry for that. Yeah, and then I would of course like to thank ASA, our partners today. It stands for Ajay Sethi and Associates. They are really well known in the market internationally, India, having more than 3 decades of experience. ASA is actually celebrating their 30th anniversary. So a big shout out to all the colleagues from ASA, especially to, of course, Ajay Sethi, in case you are here. Many congrats, Ajay, and I think this is really a great achievement, and you've led the team very well and made this 700 people family really a name to reckon with in the Indian market. Not only the Indian market, the international market. So all the best to the ASA guys. Transfer pricing, ladies and gentlemen, has always been an issue, I would say, right since the time I'm in this field since about 20 years. And of course, also in India since 1991, when more and more companies started to come to India. And that is how I think this topic has become extremely important and relevant. And of course, now with COVID, I think everything has changed. And so has the further relevance of transfer pricing. Because the companies are again reorganizing their supply chains, looking at probably new countries to start with, and also at the same time trying to see how they can minimize the cost, and also sort of increase their profits. But at the same time, I think the governments are also very careful. I'm sure Sunil and Karthik will elaborate, because the tax officers are also very careful to see that how the government's income also don't take too much of a hit through possibly any loopholes which are there in this topic. The topic is so important that actually when we were brainstorming, we thought of splitting it into 2 parts. Because there's quite a bit to cover. So that is why I would really appreciate if you already block the 24th of August, it's a Tuesday, so that you get the whole picture of this topic of transfer pricing. Let me spend a few words on our speakers today. Both Sunil and Karthik have decades and decades of experience in this field. Both have assisted various SMEs and large multinationals in devising transfer pricing policies and defending them in front of the tax authorities. So they are both experts in international taxation and actually have advised various foreign companies on investment structuring into India, taxation of expatriates, tax planning, and various other facets of cross-border taxation. So they are really the, let me say, the gurus of this topic here, and we are really happy to have both of them here. And yeah, friends, I won't take much time. I would really like to give it to our speakers. And I mean, COVID has already taught us how to live at an arm's length distance from each other. Yeah, probably two, probably both arms. Yeah. So I think today Sunil and Karthik will tell us how to manage the arm's length distance in this topic. You know, it is one of the topics of transfer pricing, so that actually we can stay at an arm's length from the legal hurdles and the taxation officers. So, yeah, a little bit about, again, Sunil and Karthik. Actually, they have something in common besides besides their specialty in transfer pricing. They are also both avid bikers. And I think both are running these Royal Enfields. So I think both of them will really cruise along slowly and carefully so that our participants fully absorb the subtle nuances of this topic. So that were a bit too many words from my side. I think I would like to give it to Sunil first and then Karthik later. Just maybe a couple of tips for our participants. You could sort of keep, in case you are at your home and using your Wi-Fi, you could sort of keep your mobile hotspot on just in case, you know, your connection breaks. So you can quickly join in from your hotspot. Um, and um, and please put your specific questions. And when I say specific, I mean try to be as precise as possible in the chat box. We will try to take maximum possible questions. We actually have already quite a few of them, but we will try and answer your questions. In case not, then we will certainly get back to you, either the IGCC team or the ASA team. So we will certainly get back to you. And with that, I call upon my dear friend Sunil to please take on. Thanks a lot.
Thank you so much, Sumit. As a matter of fact, I'd like to begin by thanking the entire team at IGCC. I think you guys have been just fabulous. Sumit, yourself, Sana, Hani, Meera, your guide have been very helpful. So friends, today the topic is a very interesting topic. Why I say it's very interesting is that the subject of COVID has given a new lease of life to the discussion around transfer pricing. Now, transfer pricing as a subject has been in existence for about 20 years now. I think in India we have seen about 12 to 15 years of audits already. Loads and loads of jurisprudence on the subject. You know, the courts have decided, people have written, the subject has been read, interpreted in such a fine manner that there was little to say in terms of what we could improve on the transfer pricing side. But then comes the issue of COVID, and COVID puts back the entire topic back into perspective. Now, the governments, you know, all over the world, Sumit very clearly mentioned that the governments all over the world are very conscious of the fact that the business are taking a hit, but they're also conscious of the fact that businesses are, going to sort of arrange their affairs in a way that could lead to tax evasion at some stage. Transfer pricing, you know, from the very core, it tries to address issues of tax avoidance. It tries to address issues whereby if there are related parties, if there are entities that are linked to each other, they're not able to sort of manipulate or manage their prices. And therefore, the need for a more robust discussion on transfer pricing right now is more important than anything else. So when, as Sumit already has said, that, you know, when we started discussing this whole subject, one thing was clear, that we wanted to cover this infamous subject of transfer pricing. But we were also very clear that, you know, since there is so much that has been written and said about this subject, there have been so many presentations happening around on this subject. Sumit and his team were very clear that we wanted to cover aspects that touch the base level discussion. Absolutely practical, experience-based aspects. And I think that is very fitting in this point in time. So what we did was we decided to break this down into two sessions. Give me the next slide, please. So we thought we could do justice with this whole subject if we were to break it down into two. You see, the bigger problem today we have is that we must understand what is the problem that is emerging out of the entire COVID episode. Is it just the incomes that are falling? Is it the expenses that are increasing? Is it only the government subsidies that are bothering me? Is it only the supply chain that is bothering me? Or is this a multiple set of factors that are bothering me? So I think it's very important to understand, and just to set the agenda for this discussion, very important to understand what are the impact areas. Uh, when you talk about impact areas, we are going to help you identify. We are not going to go industry wise. We are primarily going to focus on areas that have a major ramification across all industries. So we will try and highlight some areas that are common to all, and why they are common to all. We'll try and elaborate that to you. And then, very interestingly, given that the prime mandate is to cover practical scenarios, my colleague Karthik is going to take you through about 4 or 5 case studies, very simple, basic, experience-based case studies, which we have experienced over the last 18 months. We'll try and sort of create a link between these case studies and try and show you the practical side of the business, how businesses are suffering. And then, in today's discussion, we are going to discuss what is a high-level way forward in terms of, we will try and cut out a very clear task for the finance teams, the tax team, and how finance team and tax team should work together with the business teams, right? Today, only one person or one team cannot handle this particular problem of transfer pricing arising due to COVID. Now, the second part of the presentation, which we propose to cover on the 24th, that is going to be more focused on very critical micro aspects in terms of documentation. You see, transfer pricing is not an exact science. You defend what you prepare, what you preserve in terms of documentation. So it's very important that once you have understood the problem, once you have analyzed the problem, you try and deal with the problem. And how do you deal with the problem? You try and prepare yourself for any possible questions that might come across. And therefore, we thought in the part 2 of this entire presentation on the 24th, we could take you through very specific factors, let's say specifically covering how do you justify business losses. Businesses across the world are facing losses. It's very important for you to understand what are the critical aspects that you should document and how. What is it that is going to meet the expectation of the tax authorities, both in India and at the global level? And then once you know how do you justify or why the loss is coming to you, there are going to be some adjustments that you will make. And we will specifically speak about these adjustments in the second part of the presentation. But yes, this is something very critical that you must understand now. And last but certainly not the least, transfer pricing happens to be the largest area of dispute. And therefore, as members of IGCC, it would add tremendous value to your understanding if we were to discuss the current scenario in terms of the options that you have on dispute resolution. Starting from faceless regime of representation today, to dispute resolution panels, to safe harbor, to tribunals. What is it that is appropriate for you? We will cover the entire part, the entire discussion in the second part. Of course, the part 2 is going to be more practical as compared to part 1. But for today, we are looking into the part 1, which is really to understand the problem area. Now, between Karthik and myself, we both of us carry significant experience in terms of varied industries, transactions, risk-based assessments, international tax issues. So don't just, when you want to ask questions, don't just restrict yourselves to questions arising out of the presentation. Feel free to ask questions that may be leading to any sphere of international taxation. It's very happy to answer that. Next slide, please. So friends, when you talk about transfer pricing, there are some terms that you must familiarize yourself with. I'm assuming that most of the people attending here are either business people or tax people or finance people, and you might have come across these terms every now and then, but just for the sake of reiteration so that the explanation is clear, we are talking about various terms, but some of these which are important are one is associate enterprise. Simply, it means a related party to a group company, or like a group company or the parent company. Then we're talking about arm's length price. Sumit very nicely explained what arm's length price in today's date means. When you talk about COVID, obviously you have to maintain a third-party difference, and this is what in financial terms also arm's length price means. So the price in the open market is essentially the arm's length price, and the study of transfer pricing, the science of transfer pricing, aims to achieve and test whether the businesses are maintaining arm's length pricing or not, which is so these are elementary elements of any transfer pricing discussion. Then, typical discussions on FAR. What is FAR stands for? FAR stands for function, assets, and risk analysis. And this is the fundamental, this is the nucleus of any discussion, because as I said, it's not an exact science. Every business will have its own sets of functions, distribution of assets, and the risks that you assume between different parties, and therefore the pricing that you set depends essentially on these aspects. We will speak more about this I think in the following slide itself. Permanent establishment, a term that is often used, but today in this presentation, when Karthik speaks, one of his illustrations deal with the linkage between transfer pricing and permanent establishment, how intertwined they are, how do they talk to each other, what is the relationship, how does one impact the other. Next slide, please. Next slide, please. So, friends, let's understand the issue at hand. Why is TP getting impacted, by the way? Why are we saying that COVID has a direct impact on transfer pricing? Sumit also said initially, I think when he set the tone for this session, he said the supply chains are getting disrupted. But what are these supply chains? Any part of your business, friends, that leads to a particular transaction, any visible or invisible part of the business, it could be your inventories, it could be your suppliers, it could be your buyers, it could be your logistic chains, it could be your quality controls. Any part of your supply chain, any part of your business that makes supply of the delivery of the good happens in your particular case, either backward or forward integration, any element that is there is a part of your supply chain. And because of COVID, anything and everything has undergone a change. I'll give you a classic example here. One of our clients, this was again a European company. They had a contract manufacturing setup in India. Now, an essential part of the contract manufacturing is quality control. Now, because of the lockdown, the essence of quality control could not be met. As in, they were able to do the quality control through virtual channels, but then the product was such that it required somebody to get a good look and feel in terms of the finish of the product, and that was not being achieved with whatever parameters they were trying to apply virtually. So what they did was, obviously, it was a complete disruption. The people who had to travel from Europe to India, they could not travel, quality could not be examined. So obviously they found a fix to this whole problem, but that essentially involved more cost. And the fix that they chose for was that they took a sample of these products. Somebody specifically traveled from India to a place where travel was allowed. The head office, which was to buy these products, they sent a quality inspector, a team of quality inspectors to this third location. They did the sample quality check and they had to satisfy themselves. But all of this, there was a cost of time, there was a cost of making these facilities, there was a cost of travel, whatever travel was involved, and obviously it got disrupted. My normal business got disrupted. Similar thing would happen if your company were to undergo, let's say, a lockdown due to, let's say, shortage of material, shortage of power. Let's say you have a labor unrest in your factory. Anything and everything that gets impacted is a part of supply chain. And COVID obviously has left no stone unturned in disrupting our businesses. The second part is something that deeply impacts us is change in contractual obligations. I'm sure you've all attended many discussions around force majeure. Now, what is force majeure? Force majeure is a clause that is there in every legal agreement. It says that if there is a calamity or there is anything beyond the parties, the contracts cannot be enforced. So a lot of parties, either the suppliers or the buyers or the service providers or the maintenance providers, or the license providers, people have taken shelter under this force majeure clause. And why has that happened? It has happened because COVID impacted their ability to fulfill their commitments. And therefore, there has been a significant shift in the way people have met their contractual obligations. There have been differences in timings. There have been differences in the way people have actually fulfilled their obligations. So the tone and the tenor of the contractual obligations have changed, right? People have gone into disputes, whatnot. Financial performance has obviously been inconsistent. Now, inconsistent may not always mean that the financial performance has been bad. Financial performance has just been inconsistent, right? For example, during the initial phase of lockdown, let's say talk about India, 2 or 3 months when we were in extreme, complete lockdown, the demand got impacted to a great extent. But the moment the economy opened up, the markets opened up, there was a pent-up demand, right? And suddenly the companies realized that they broke all records. And therefore, while one quarter performance showed something that was a very grim picture, the other quarter showed a very different picture altogether. How do you measure it? What is the yardstick against which you measure it? There is no yardstick that you have. The only yardstick is if the same business must have faced any other or a previous calamity in any previous period, you could try and compare that. But again, you cannot compare it with any immediate periods. Therefore, the performance has been anything but consistent. That obviously requires a deep thinking. Shift in point and timing of decision making. So essentially, friends, I've mentioned about permanent establishment having a deep connection with what we're discussing right now in terms of transfer pricing. Now, the issue of permanent establishment depends largely on how, to what extent, and what decisions are, where the decisions are made. Now, due to these lockdowns, sometimes it is possible, as a matter of fact, it did happen, that decisions that were supposed to be taken by the head offices were taken by the subsidiaries. Even as a matter of contractual obligations, the decisions that the head office was to make were eventually taken by the subsidiary. Let's say a decision on quality. Let's say a decision on recovering money from a client. Let's say a decision on altering any critical terms and conditions relating to a contract with a customer. These are very critical decisions, and these decisions can easily lead to a situation of permanent establishment. But how does this impact the situation on the transfer pricing side? We can elaborate that. I think Karthik has one of the scenarios that he's going to present. He's going to address this particular issue. Funding requirements, my friends. I believe most of you must have seen this happening. Funding requirements impacted you obviously in different times, in different manners. Your fundings got delayed. Your fundings came earlier than expected in some cases because people just wanted to get done with the funding part. Your funding, the rate at which the cost of funding changed drastically. In a lot of countries, the governments have given you a lot of incentives. So the raising money became cheaper, and therefore the head office started raising money that was cheaper than expected, cheaper than what they were getting in the pre-COVID times. And this money, when it is passed over to you, obviously you would expect that money to come cheaper to you as compared to what they were charging when they were sourcing money from an external source, from a bank, let's say. Now, obviously, that is going to have an impact on your profit and loss, and indirectly on your transfer pricing, and that is something that is a very critical factor. Last but certainly not the least, friends, digitization has played a very important role in helping businesses recover from this entire COVID situation, and that applies to all facets of changes that you see on the business side, whether it be supply chain. You have new techniques, let's say, of quality approvals. You have new techniques of intercompany reportings. You have new techniques of deliveries, inventories. Anything and everything has changed. Everything has gone online. Today, we are having this session also online, and these sessions were done offline very often. So technology has made a lot of change. Now, some of this change is going to, we are going to retain this change for times to come. And this is going to evolve as you sort of evolve in the process of your businesses. When I speak about specifically about Germany, Industry 4.0 is something that they've been wanting to introduce, and that has been in introduction for a long time. I spoke to a lot of companies. They said that in the process of digitization, in the process of accepting blockchain, that happens to be a very critical part of Industry 4.0, they had to speed up the process of implementing Industry 4.0 into their factory setups. And similarly, there could be many examples of how companies have adopted technology to deal with the problem of COVID. Now, friends, all of this is going to have an impact. The impact is going to be on our profit and losses, and the impact for a specific transfer pricing purposes, the impact is going to be on your functions and risks. And as I said in the beginning of the discussion, FAR, function asset risk analysis, is amongst the most critical aspects of any transfer pricing study. So anything and everything that we have discussed will impact anything, any function, and any risk that is critical for the purpose of arriving or looking at the appropriate arm's length price for the purposes of transfer pricing. Next slide, please. Now, I think we understand most of where our problems are coming from. We have understood the impact areas. We've understood what is it that is troubling us. But how does it exactly make an impression? How does it exactly make an impact? What are the critical transfer pricing considerations that I have to keep in mind? I think most of it we must have already covered in terms of the earlier slides. But frankly, and as you will evolve, as you will see this presentation building up, you will realize that all the critical aspects of the presentations of the businesses have undergone a change. Now, when you talk about policy setting, it's any principal agreement between the Indian company and the parent or the group companies. Now, that has undergone a change, either by force or by COVID or by situation, anything and everything that has led to this change. How do you implement any particular policy? That has changed. How do you even monitor? I give you an example of quality control, how it was done in a very complex situation. How do you document? And documentation is something we will discuss very deeply about, and you will realize how difficult, how complex, and how critical documentation has become. And again, some of you might have already had an agreement with the regulators, either in India or in your headquarters. That has also undergone a change. A simple agreement like an APA, Advanced Pricing Agreement, which is an agreement that you sign for 5 years with the regulators, that is based on some very basic fundamental assumptions. Now your business assumptions have completely changed. You are not the same creature as you were in the pre-COVID phase. Should you or should you not revisit the agreement that you've had with the regulators? That's a question. Now, friends, even within the group, you will see the impact building up differently on a division level, location level, accounting period level. A typical example could be, let's say, a company that has 2 segments. They have automobile and they have healthcare. We all know healthcare has done brisk business, during the COVID phase, and automobile hasn't exactly done good business. And therefore, you will obviously find difference in the way businesses are getting impacted. Now, one thing is common. What is common is that there is an impact caused by COVID. Is it positive or negative? That is something that you have to gauge. Also, something that is going to be interesting is that the impact is going to be there for multiple years. Some things that have happened to you by virtue of COVID, you will just adopt them for good. Some things that you like, digitization is something that you like, and you're going to accept it. You will run it for multiple years, right? With or without COVID, that doesn't matter anymore. So the new normal, where digitization plays a very important role, will obviously prevail and obviously evolve with the passage of time. Now, friends, I think we all understand very well that when you discuss about the relationship between taxpayers and tax regulators, you very clearly understand that the onus to substantiate your position always rests with you. The taxpayer is going to ask a question directly or indirectly. The onus is on you. How well and in what robust manner do you try to explain your position, right? And since the onus is on you, there is a dire need for businesses to evaluate what impact has been caused on their businesses, identifying the pain points, identifying the points that have made the difference. And you have to very clearly undertake an analysis and document. And that's where you see a constant evolution that will happen, where you will have to identify, analyze, and keep improving and keep documenting what you do. Next slide, please. So Karthik, over to you for the practical scenarios.
Thanks, Sunil. So I think, Sunil has given us quite a good brief in terms of background of what is that we were wanting to discuss about as well. So one of the key things that I think all businesses will look to is to always look to see how we can adapt to a given situation, and not necessarily, at the beginning think about what will be the tax implications. It cannot not necessarily work that way. Tax has to generally follow the business. So a lot of changes can happen over a period of time in terms of how we have conducted business in reaction to the situations which have arisen over the recent times. And then while all those changes would have happened, and some of them may have started off as being a stopgap arrangement just to see that, since there's also this uncertainty of how long these things will last. So maybe some things could have been done at the beginning to say, okay, let's just do this for this instance or a couple of more instances. And then over a period of time, it may be seen that maybe doing the business this way, or the new way that may have been done in response to the changing situation, may have been more beneficial. And then probably the businesses decide that, okay, this is not a bad thing. Let's maybe continue doing that going forward as well. So while all of these changes are of course necessary and valid, and primary focus being able to run the businesses, there could of course be tax implications, and that's not something that we should lose our focus on. So what we've done is to identify a few scenarios that we felt in the recent times of how businesses may have evolved. And as I said, some of this can be more temporary, or once begun may have also become the norm in terms of how the businesses are going forward. Next slide, please. So the four areas that we thought we could touch upon is, beginning with, one is on the impact on the supply chain side. The second is a situation where there could have been any increase or reduction in business activities in terms of additional things that a company may have done. Third is changes in relating to inventory management. And fourth being some activities which we have done and which possibly can create a exposure to permanent establishment risk. Next slide, please. Coming to scenario one. So this is a situation where we would have seen instances where there are Indian entities which are primarily operating as a contract manufacturer, where the Indian entity did not have to worry much in terms of either the selling function, because of course all the sales are generally to the group entities, and also equally possibly on the sourcing side of the things, where group used to function as the sourcing hub, one of the group entities, and then they would identify vendors, do the quality checks, do the bulk negotiation for bulk purchase of goods, take the goods, and then supply to all their subsidiaries, including in India, based on the Indian subsidiaries requirements. But of course, we know that over a period of time now, in the recent past, there have been huge disruptions in terms of supply chain, either not being able to source the goods, or even when goods are available, the modes of transport being not available, or the costs relating to the transport being prohibitive. So in such instances, it may have happened where the group says that at this point in time, we cannot have our manufacturing line disrupted or stalled just because we are not able to either procure and then send it to you directly. So why don't you go ahead and deal with the vendors directly and procure the raw materials or the goods that you require in order to keep the manufacturing line moving. Two things could have happened here. One is an instance where the group could say the vendor is already identified, we know the quality, the price is also already agreed to. All you need to do is place the order on this vendor and get the goods as much as your requirement, rather than where earlier group used to procure in bulk, and then now India can identify what its specific requirement is and place the orders on these vendors. Or it could be a second situation where the identified vendor is possibly not in a position to supply, and then the Indian entity now had to look at a situation where they had to start afresh in terms of starting from identifying vendors, doing the quality tests, and then negotiating on the prices, and then agreeing on the modes of transport and all of that things, and then ensuring that they have continuous supply of the materials that they require. In the first instance, while it may not seem a big change where everything is already there, instead of the group ordering on my behalf and supplying to me, I just go and buy from the same vendor at the same price. What this could really lead to is a situation of something called as a deemed international transaction. Basically, a deemed international transaction is a situation where, though the transaction is between the India entity and a third party, if the substantial terms and conditions relating to that transaction is already predetermined or influenced by the group or one of the group entities, then that would be classified as a deemed international transaction from an Indian tax regulations perspective. While what that will need to happen is, for us to be able to identify if there have been such situations and ensure that at the when we do our compliances, we do take note of such a situation and make appropriate disclosures, because there is a mandatory requirement to make appropriate disclosures in relation to this aspect. The second situation is where, as I said, where the Indian entity itself then now goes on to take the functions lead in terms of identifying vendors, doing the quality control, and negotiating for the prices and all of that. Typically, what this would lead to is a situation where there is a significant change in their function on a supply chain from a supply chain perspective, and therefore, initially when the contract manufacturing arrangement would have been agreed to, the pricing and the risks and functions associated would have been limited to possibly just manufacturing and selling, but now all of these additional functions have also come into the Indian manufacturers' responsibilities, and therefore, the appropriate action will have to be taken in terms of acknowledging that India is therefore undertaking significant additional functions in this regard, and then suitable adjustments will have to be made in terms of both the contractual arrangements, and again, appropriate disclosures need to be done in the documentation. Just to extend this, this can also be a situation from sales side as well, where let's see a situation in probably 2 years ago, the group realized that there is scope for increasing the capacity in India, anticipating further orders from their customers across the world. And suddenly you have created a capacity, and then suddenly we see that we're in a situation where the group is not able to get all the orders that they have been able to that they were anticipating. And from an India perspective, we know that the supply chain is good, the goods are running, the lines are running. So then the India entity would say that why should we lose out on all these opportunities that may be there, because I'm able to run my the factory here without any disruptions, thankfully. So why should I stop the line just because I don't have orders at the group level? Why not I take the lead and see if I can find customers in India? For example, let's say typically in the case of particularly in the given situation, there's been a huge demand in the health sector in terms of medical equipment or pharma sector, for example. So if there is any contract manufacturer in India who's possibly in that industry, he would be thinking that there is sufficient demand for these products in India itself. So why don't I take the lead and identify the customers and go ahead and sell them till the time maybe the group orders don't start flowing in? I can continue to run the business and then cater to the needs in the domestic market. This again, I guess, entails a significant change in the activity that the Indian entity would be carrying out, because at one end, while it may continue to do a limited activity in terms of contract manufacturing and supplying it only to the group, uh, taking on these additional roles in terms of selling to the customers directly exposes it to a lot of additional risks in terms of being able to market in the Indian market, and then ensuring that they're able to recover the monies that they are owed from their customers, etc. Which is of course not something you would be facing as being a pure contract manufacturer. So that again will entail relooking at the Indian entities functions and then making suitable arrangements, adjustments to this Indian entities profile. Next slide, please. The second scenario that we were thinking that we thought was again possibly quite a possibility is a situation where, again, as a starting point, the Indian company is a contract manufacturer, and then it is manufacturing the goods using the group's technology and know-how, and then supplying goods to the foreign company. Whereas suddenly, and some of these goods could be standard, and some of them can be customized, where wherever there is any customization required from a specific customer requirement perspective, the group would do all the work in terms of making those modifications to the standard products to ensure that the customer's requirements are met, and the revised specs would be shared with the Indian company, and then the Indian company would make those suitable changes to its line in terms of carry out the changes in the manufacturing process, and then deliver the goods. But again, it could be a situation where because of people, and of course the situation has also hurt people in terms of lives, loss of jobs, etc. And and attracting people and getting people to come on board is also been a difficult situation in the recent times. So there could be instances where, because there are no people at the group level who or people who were there have been lost because of the situation, and then the group is not able to carry out those modifications that the customers are requiring, and then therefore not being able to pass that on to the India entity, and India is not able to keep its line running again. So and the Indian entity could say, hey, I have people here. They may not have done this activity function specifically, but they are vastly experienced. They have the knowledge. They have the know-how to do it. So why don't we start off by sending me a couple of these things? Let me let the team here come up with suggestions of what are the modifications required, and then if you're okay with it, then we can continue with the manufacturing. And then what may have started off as a couple of instances where the Indian entity's personnel would start doing this additional activity in terms of making design changes or modifications to suit a customer requirement. Suddenly the groups, the senior people in the group feel that, yeah, this can be done here, why not? And then suddenly over a period of time, what may have started off as a 2-people team could suddenly grow to about 15 people, because we also see that not only these, we could easily hire more people in India, say, with the requisite skill sets, and not having difficulty finding such people elsewhere. And then this suddenly becomes an additional activity compared to what I was doing earlier, which was purely contract manufacturing. This again is a change that which is distinct from doing manufacturing, because this is more in terms of providing a value-added service, and therefore becomes a distinct activity by itself. And therefore, this is again something that will have to be looked at, and suitable adjustments will have to be made, or modifications in how we approach transfer pricing from this perspective as well. Moving forward, next slide, please. The third scenario is a situation where let's say there was a trading company in India which used to, or a distributor as we would want to call it, which was taking very limited function in terms of inventory management. They always had a sense of what the market requirement was, and then whenever there were secure orders from the customers in India, they would place back-to-back orders on the group and then source the goods and supply to the Indian customers with very well-defined lead times, etc. Again, given the supply chain disruptions, the Indian entity people they here would think that there is so much demand in the market, and while earlier we could manage our supply chain well enough to ensure that I didn't have to stock the goods here, but today I may have a situation where if I'm not able to get the goods in time, and then I may end up in a situation losing the contract or the business, and I don't want to be in that situation because there is a good market here. And in such a situation, with an Indian company would then possibly take a call to say that, so why don't I start doing inventory management? Now, inventory management is a whole different ballgame by itself, right? Because it has to start with having to create additional space to be where these goods can be stored. Then we'll have to anticipate what is the mix of the inventory that I'll keep. Is it product X or Y or Z? The anticipated demand that I foresee over the next few months. Because having seen the situation where I may not be able to quickly have the goods delivered to me every fortnightly or monthly as it used to happen before. Now I can possibly get goods only once in 3 months or 6 months because of the tremendous strain which is there on the transport situation as well. So I'll have to think about what is the mix of the products that I'll have to would want to stock up. Then and then certainly, of course, that increases the quantum of inventory I have. Then it brings into the question of, okay, I estimated that maybe something will be sold, and then suddenly I have probably 100 units of it, and then I'm able to sell only 10. So what happens to the remaining 90? I have to keep that in my inventory for a long time to ensure that that I do manage to sell it off at some point in time. Again, all of these things means additional costs, additional responsibilities, additional function that the Indian entity is undertaking. Which again, as I said, could be a temporary thing or a permanent thing, or it could also be a permanent thing for the reason that we suddenly see that having inventory management having inventory in India has possibly helped us scale up our operations a lot faster and in a larger way as well, where we are quickly able to, and customers also today where they have been able going to our competitors and they are struggling to supply goods as well. Then they suddenly see that, hey, this entity has this vendor has all the goods that we need and they're able to supply quickly, so why not move the business here? So so this possibly could have started off something as being a stopgap arrangement, could have again been become a more permanent feature. So having added a significant additional function in terms of managing inventories is something again which will need a relook at how the transfer pricing arrangement within the group will be. Next slide, please. The fourth scenario we're talking about is a situation which is possibly a slight modification of what we were touching upon, where the earlier entity was a distributor, whereas in this situation, the entity used to be a pure marketing service provider. So a pure marketing service provider or support service provider are entities which are ideally not, of course, neither have to worry about inventory, nor do they have to worry about having getting into contracts with customers, because the sale contracts are entered into between the group company outside of India and the customers in India directly. And the only role that the India entity had earlier was to purely act as a channel of communication with absolutely no influence in terms of the contractual terms of the sale arrangement. But again, given the situation where the Indian entity's personnel feel that there's not enough movement happening, there are delays which are happening in terms of communicating back and forth, and then the Indian entity sees that, again, why should we lose out on this business? So let me take the lead, let me agree things with the customer. I'll agree with him in terms of what is the quantum of goods you need, specifications of the goods that you need, what are the delivery terms, what are the payment terms, the pricing also. All of these things, somebody in the Indian team would have taken the lead and then agreed to substantially with the customer. And then whenever the communication happens with the group, we tell them that this is all agreed, so can we go ahead with it? And then the group says, yes, let's go ahead with it. while this is of course a big change in terms of what I was expecting to do and what I have ended up doing. And this is something which can happen very naturally without without even somebody being aware that this could cause any issues from a tax perspective. Because business people are very passionate about how they want to ensure that we keep doing more and more business, and then whenever there are opportunities that we don't want to lose out on, we end up taking more things and doing more things than what the structure as from a tax perspective may have envisaged, or and then this can cause and this of course again alters the character of this Indian entity in terms of what they have been doing, and definitely creating a chance of a pay risk for the group entity in India. Similarly, from a services perspective as well, and I mean this is something we have seen, which is a little something that we've seen over recent time happen a lot more compared to earlier, where at least from a marketing perspective, there may have been instances that may have happened in the past, but now this being a more permanent change. From a services perspective as well, we've seen instances where typically the arrangement is where we have a customer outside, there is a group entity outside, and the customer contracts are entered there, and some piece of the service activity in terms of execution is outsourced to Indian entity. And in the course of that execution, the Indian entity's employees, in conjunction with the employee group entity personnel, would be interacting with the customers as well, the end customers primarily. And over a period of time, again, of course, Sunil was also touching upon the need for digitization and going forward. Let's assume this is a situation of a digitization support that the group is providing to this customer, and then with the change in scenario, the customer suddenly feels that I have to add X feature or Y feature. How do I add payment function into my the product that you're developing? And then again, unknowingly, subconsciously, the conversation, since the customer is also has interacted with the personnel in India, the conversation starts off, and the Indian employee says that yeah, this could be done. This is the idea. This could be the design, and this is the technology that we could implement. These are the number of resources that I will need. In terms of man hours. This is the pricing that we generally look for, and all of that. And quickly, this discussion could have developed over a period of few days, and suddenly everything is finalized, and then when the when we have these weekly calls with your with the group, and then the Indian entity person says that look, and this is the customer, this is what he was requiring, and this is what we have already agreed to in terms of what the design can be, what's the level of efforts involved, what is the technology that we will use, what is the design, and all of it. Again, this is a big change, because the approach all this while has been, or was, that the primary decisions in terms of how the project's execution will happen would happen at the group level, and then India teams would coordinate with the group entities to ensure that the projects are executed in a timely manner. But over here again, we've seen the Indian personnel take up a lot more function and responsibilities in terms of agreeing the scope, the deliverable, etc., which again is a big change in terms of the functions and responsibilities that the Indian entities want to undertake as compared to before what they were doing in terms of only executing the work. So hopefully these are some scenarios we thought we should touch upon, which could people could relate to, because as I said, these are business decisions which happen very quickly, and people tend to react to situation and not having to think about tax, and rightly so. I don't think it should be a case where business should stop itself thinking about what will be the tax implications first, and then I will think about how I will go forward. Businesses have evolved and things have changed. Now the question is, of course, that we need to step back and say that okay, these changes have happened, or have happened for some time, or having experienced that it has worked well, we may want to look at it from a long-term perspective as well. So then comes the next step, as to say that okay, then what is now the impact from a tax perspective or a transfer pricing perspective? What more that I need to do to ensure that I'm in compliance with the requirements here? So what additional things that I need to do to ensure those things are not taken care of? to say. So therefore, I think the key thing is, of course, to identify these situations and see if there are such instances which have happened. And importantly, whether it is for some period or for a longer term thing, it is necessary to identify them and then address them in terms of modifying your intercompany arrangements or agreements, as the case may be, documenting all of these additional functions that the Indian entity has undertaken partially or temporarily or from a long-term or continuous basis going forward, and then determining what should be the additional compensation, if warranted, that India should earn for carrying out these additional functions. So hopefully this has triggered some thoughts in your minds, and will give you a chance to relook at the situations that you may have faced in your companies as well, and then think about having a relook at it in terms of how we can deal with the situation that we are in. Next slide, please. Over to you, Sunil, now.
Thank you, Karthik. Thank you. I think by now we already understand where the problem is, or if we haven't been able to cover any specific situation, now at least we have a very clear guidance on how do you look for and identify factors that are contributing to change in my transfer pricing. What is prompting it? Next slide, please. So I think what is the way forward in terms of you have now identified the exceptional situations, you understand what are the circumstances, you understand what went wrong or what went differently, but it's water under the bridge now, you cannot do anything about it. But what you can do is you can try and prepare yourself in terms of documentation and try and justify a position why you took a particular decision. So I think, and as we say, when we do the tax representations and when we face the tax officers, I think the most important point as advisors is to guide you to ask the right questions. What is it that you want to analyze? What are you analyzing? You know your problem now, but how do you make sense of this problem to be able to identify these factors in sum and substance, and then document these factors? I think that's something which is left for every CFO and tax head to do. But essentially, we thought some guidance here could help you. So what are we trying to do? We want a very pragmatic approach. Listen, if there is a lockdown, if there is a labor unrest, if there is a cessation of your business operations for any reason, you consider that period, that event as an extraordinary event, right? So the most typical way to look at your financials is by taking the impact out of what is exceptional. It's like a snake bite. You have to take it out, right? So in terms of COVID, what some countries have, some countries have come out with very clear guidelines. For example, countries like Singapore, Netherlands, they have very clearly said that, look, we want you to declare in your financials, in your notes to accounts, in your transfer pricing documentation, a situation that reflects your financial performance, but for COVID scenario, but for COVID impact. And that is amongst the most important aspects that you must know. So what do you do? Essentially, it's a simple analysis that you would have done many times, right? To identify any exceptional event. Let's say you had a quality issue and the quality issue has spread across one region. How do you find that problem in your products, in your finances? It's the same manner. You draw a set out completely. So you draw a P&L, you try and identify reasons for variances. So again, asking the right questions, right? So again, start asking questions. How do I adjust my profitability to reach to an outcome expecting that COVID had not occurred or any exceptional event had not occurred to us? And friends, very, very important part is that you cannot just only consider negative factors. Believe me, your business is not only impacted negatively. There is a positive side to the business as well. There is a lot of cost saving that is happening. Your travel costs are being saved above all, right? Your management costs are being saved. Your office maintenance costs are being saved. Lots of savings on the anvil. So therefore, asking the right questions, I'm not going to read out the questions. These are very common, very obvious, something that every CFO would have already asked. But from a transfer pricing perspective, you should expect that the tax officer will ask these questions. If he doesn't ask these questions, all he says is justify your loss or justify your performance lower than expected performance. He's just using the term performance. Performance entails all these factors. All he's asking is justify a performance for the COVID period. What do you do? It obviously leads to questions like these. Unless you have done this analysis, it's very difficult for you to sort of come out with the right set of answers, right? And you know, again, last but not the least here is that you have to identify that there are some differences which would have happened to all businesses, which are permanent, which is happening to an industry, right? For example, digitization. Let's say the COVID thing continues for the next 3 or 4 years. It might take time. Let's say by that time, there is a basic assumption that Industry 4.0 would have been implemented at all major, let's say, German companies in a particular industry or across industries. So your comparable set, you are comparable yourself. Let's say an Audi compares itself to a BMW. Now, it is an assumption that what has happened to me would have happened to them also. So there are some changes that are going to be permanent to me, permanent to the industry, permanent to the environment that I operate in. Identify those factors very, very clearly. And then there are some temporary factors. You were able to not handle a situation in a precise way. In hindsight, you obviously know that you did a mistake. These are temporary factors. It's specific to you. It's specific to that time. It could have happened to anybody, and therefore this is not really common to the industry. It's a normal problem happening to you. Identify these factors very, very well. Next slide, please. Now, again, this is one of the analysis that we did, and while we were sort of analyzing a company that is headquartered in Singapore, and there was a request that we must try and identify the contract manufacturing setup that somebody had in India, a company managed through Singapore, but again, a European company. Now, the mandate given to us was that we must try and differentiate to understand the impact very clearly. We go one step back and one step forward. So to understand the real impact during lockdown and how lockdown pricing should be or should get impacted, you have to see what is it that was happening to you before the lockdown happened. So in this particular case, this was business as usual. We are talking about a contract manufacturer. Business as usual, contract manufacturer was being remunerated on a cost plus basis. You spend 100, you get 105, end of discussion, quality, blah, 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 all issues handled, no problems. Now, during lockdown, understand that this contract manufacturer is a risk insulated entity. It's a loss insulated entity. It could not have performed any function. It could not have approached any other customer because it makes proprietary product for a proprietary client, for a proprietary technology. It could not have worked anywhere. So the tax authorities are going to expect that, look, you are a loss insulated entity. Loss happened to the entire world. It happened to the entire, all the states in India. And therefore, it's a common factor across industry. If you were not adding value to the group, at least get remunerated at cost. And that's a very valid argument that anybody could give you. And you must have very clear arguments to rebut it if you don't agree with this. But this is something that we arrived at in terms of analysis that we were doing. Again, post lockdown, everything is not going to come back in normal functioning right from the word go. There is no date that you can select that the operation will start 100%. So obviously, based on the time that your job is done and delivered, you simply follow the pre-COVID pricing formula. And again, based on the time that you are on lockdown or intermittent time when you are in lockdown, you try and compensate at cost or unutilized capacity at cost. This is a very sensible, very simple, very logical, but again, very demanding analysis that done. So what you saw in the previous slide was a financial analysis, the question that you asked. This is a functional analysis, and the writing that you see in the bottom is the outcome of that analysis. This is what we could arrive at in terms of understanding the entire situation. Next slide, please. So what do you do exactly? How do you document? Obviously, this is just an illustrative set of pointers that we have for you. We will dig deeper when we do the second part of this discussion on the 24th. Now, evidence is king. Transfer pricing is all about evidence. You may be making margins that are twice the industry margins, but again, unless you have evidence to show that these margins are a result of normal business operations, are sustainable margins, you fit the industry which you are comparing yourself with, you fit the comparables that you're comparing yourself with, it means nothing. So whatever changes that have happened to you, evidence is king. And now to collect evidence, it is not the responsibility of your tax advisor, not just of the tax manager, it is the responsibility of the businesses equally. I will, as a takeaway, I think that is something that you should preserve. Limited risk operations, again, entities that are, we discussed the case of a contract manufacturer, again, subsidiaries that are underperforming, subsidiaries that have a limited risk in a sense. Now, these subsidiaries will have to be given some compensation, right? Now, this is going to have a very huge hit on the profits of the group, but there is nothing that you can do here. If you have to book losses in the limited risk operations, you better have very strong and solid reasons supported by paperwork for that. Benchmarking, a very critical aspect. Just to make you aware, what is benchmarking? Benchmarking refers to a comparison that you do with the with identical transaction or fellow companies in the industry or fellow industries. Now, remember, all over the world, the timelines to report the financials and the performance, otherwise the timelines have gone haywire, and therefore it's very difficult. It's going to be very difficult for you to be seeing any comparable data available in the market. So benchmarking is going to be a problem, and therefore you must have circumstantial evidence. And therefore we go back to point number one. What is the evidence that you have that can support your benchmarking? Service fee, it's a contentious issue anyways. German headquarters charging the Indian headquarters a license fee for what? For trade name, for technology, for anything else. They are charging you support for supervision, for services, for installation, for commissioning. Now you will have a more important task to justify all of these expenses. In some industries, in some companies, the allocation of service fee happens on the basis of allocation key. Now those allocation key, because Karthik mentioned there is going to be a redistribution of risks and functions. Now the allocation key must change, and you must exhibit the change in the allocation key. Again, as I said, these are just pointers to begin with. We'll be very happy to take up more in the next phase of this presentation. Last slide, please. This is a snapshot of what we are going to be dealing with in part 2 of the presentation. So we will try and deeply analyze what are the plausible causes of incurring business losses and how do you justify it. And we have mentioned some pointers here, and this will be, I'm assuming 90% of these will be common to all industries, all companies, even profit-making companies. If they have earned less than expected profit, that should also be analyzed in line of the discussion that we will have here. Again, there will be adjustments, right? A lot of critical factors across industries have changed in terms of availability of funds, in terms of capacities, in terms of your forex earnings, your exports completely stalled, so on and so forth. And again, we will throw some light, more experience-based light on what are your options in terms of dispute resolution. That, friends, is a sort of a conclusion to the presentation that we have today, the part 1. So just to reiterate, the 3 key takeaways that we feel that you should carry from this presentation is: one is it's your onus. It's transfer pricing is your baby. It's your document that you have to defend. So remember this. No documentation is enough. Do as much as you can. The regulators are going to be aggressive, not just in India, in Germany, all across the countries. They, at some stage, they will make your life difficult. Believe me, you will face very, very tough questions. Last but certainly not the least, you have to work closely with the business. You cannot tomorrow take an argument that you are finance people and therefore you do not have adequate access or understanding to what the business does. And business always takes the decision first and you are there to defend it. It's not always true. You have to educate, you have to work as a team with your businesses. And believe me, that is going to go a long way. Next slide, please. And with the next slide, I hand it over back to Meera. Thank you very much.
Yeah, thank you, Sunil and Karthik, for the very informative presentation. So we'll just quickly take some questions because I think people are waiting for some responses. Okay, we'll start with the first one. What is the key difference between associated enterprises and PE?
Karthik, do you want to take one?
So essentially, an associated enterprise is any entity which is within the group. For example, so group has entities in US, India, China, Malaysia, Germany, right? All of these are associated enterprises because they are all group companies. Now, PE can become PE is that one entity within the group which is undertaking a lot more functions on behalf of one of the group entities outside India and is seen to be doing it on their behalf and not acting independently. Taking an example, for example, let's say there is you're going back to the situation that I was talking about, right? Where let's say Indian entity is a distributor, right? And then it is buying goods and selling in India. So both these entities are associated enterprises. But in a situation where India is taking the decision on the pricing, contractual terms, everything, and then the overseas entity is only rubber stamping it, and where the sale happens between the group entity and the customer in India directly, that is a situation where there could be a exposure of PE, or the Indian entity could be looked at as a permanent establishment of that foreign entity in India. Hope that sort of helps clear the understanding.
Just to add a point here, every associated enterprise is not a PE, whereas the converse is correct. If there is a PE, it will likely be an associated enterprise.
Okay, thank you very much. Thank you. Yeah, sorry, Karthik, do you want to add something or can I move to the next question?
Next question, please.
Okay, so there are a couple of questions which are pretty similar. So IT consulting or software product companies who have a cost plus model with the parent company and that has not been able to, I mean, due to COVID, it was not possible for the group company to meet with the cost plus requirements. So the companies therefore are facing a loss. So the question is, how can we justify this loss for the last year in terms of TP documentation? And second part to it is, can the Indian subsidiary raising a cost plus markup invoice to the foreign company reduce their margin because of this scenario?
So
yeah, sure. So on the first part, I think this is something which Sunil was just touching upon at the end of the session as well, where while I know it's a tough situation for companies and within the group as well, but from an Indian tax regulation perspective and the expectation that we see from tax regulators in India, what we would suggest is that even if the group entity is not able to pay to the Indian entity a cost plus a markup, at least cost reimbursement, full cost reimbursement should be looked at the bare minimum, or to ensure that that there is not a situation of a loss in India, because typically for a cost plus entity, loss is a strict no in India. There can't be a situation where an Indian entity under a cost plus arrangement can have losses, which is in this situation, because ideally the thought is that the Indian entity undertakes most of its functions to the group company, so therefore they should be adequately compensated. Coming to the second part on whether the markup can be reduced, I think this is something which we'll have to wait and see, because which in fact these are some things that we'll also touch upon in the session on Tuesday as well. But just to give a brief explanation, I think it will be a good to do a wait and watch kind of approach, because the way a markup is set up is also based on comparability analysis to see how companies have fared, or independent companies have fared, and what is the profit margin they're earning, based on which I can then derive what the markup that I can use can be. So given where we are today in terms of availability of financial information of other independent entities, an immediate answer to whether markup can be reduced or not is not something which is straightforward. Once the financial performance of the independent companies are also looked at, and then we see what is the profit range that they are operating in, then we can take a call on whether a markup can be reduced within the range that is available based on what the independent companies are earning.
Okay, thanks a lot, Karthik. Okay, moving to the next question. In scenario 2 and 3, I guess he's referring to your slides. When the subsidiary deals directly with the foreign vendor, it becomes a deemed international transaction. Won't this fact itself again help the Indian company to retain its characterization as a contract manufacturer?
So in scenario 2, yes, to the extent where they are dealing with the foreign vendor directly, as I said, but that's what I said. So there can be two instances where one is of a situation where the Indian entity is only limiting itself to placing orders on the foreign vendor. As I said, there will not be a big change in the characterization per se, rightly so. But what will have to be kept in mind is, of course, from the deemed international transaction disclosures perspective. In the second situation where the Indian entity is taking a lot more impetus in terms of going into the activity of identifying vendors, doing the quality control, etc. While even within a contract manufacturer, the intensity of what the contract manufacturer does, can differ, right? This, for us, in the situation that we were talking about, the starting point was a situation where the contract manufacturer didn't have to do any of these things. And then all these additional functions will possibly mean that there is a chance for higher compensation that India may be expected to earn for the undertaking this additional activity and responsibility, because ensuring that the quality of the materials that I use is very important in terms of me being able to manufacture and supply to the foreign entity, because that's the final product which the group will then sell to customers. And any issue in quality control or not having vendor supplies coming in time, all of that can cause disruption in terms of quality as well as the supply chain as well. So
okay, thank you. Okay, I mean, I'm just going to take this question. I don't know if you can answer it right away, but I mean, we will also inform the people to send in their questions additionally, and we can address them over email. So the question is there any free trade agreement with Malaysia or any other country? If so, what is the tax and tariff for Malaysia and China?
So I think Meera rightly said, I think this is a completely different subject, and we can separately respond to it. There are teams who would deal into the FTAs, and we'll be very happy to respond separately on this point.
Okay, yeah, thanks, Sunil. So we'll write to the participant who's posted this question and ask them to get in touch with you all offline. Okay, then another question is, what is the current trend of APA authorities, whether they are allowing some downward adjustments to markup?
Again, the next session that we're going to do, Meera, will cover the recent attitude and the positions taken by the APA authorities, as equally as the other authorities, the MAP, the APA, the local, the first and second level of authorities. So I think we can remember this part and we can address this question specifically in the next session. That is relevant to the next session.
Okay, I got that. Sorry, when I read the entire question, I realized Karthik had already addressed it in the previous question. Okay, there's one more which says that if a company is having an upward trend of being profitable as a service company, what will the scenario be for them?
I would say it's an open-ended question, but I'm assuming that they are worried about the COVID taking away the upward trend or COVID disturbing the upward trend. Again, and I'm repeatedly saying this, we will talk about more detailed documentation in the next session. But yes, if they have valid reasons to substantiate the reasons for the downward inclination of the profits or the performance, it will have to be seen on a case-to-case basis. But if they have sufficient documentation, that's absolutely fine. On the other hand, if they're doing even better in COVID times, no reason.
Okay, got that. Okay, we'll take just one last question because we're already much over time, and then we can address the remaining questions, if any, via email. So how to do benchmarking for financial year 2021? Because 2021 data is not available in the database, and we have to consider 2 years data for the comparison.
Karthik, do you want to take this one?
Sure. I think, yeah, the requirement, again, this is something which we were anyway planning to touch upon in this next session as well, but quickly, the regulations require that we look at 3 years data, and it does give us the flexibility to look at only 2 years data at the minimum, and then if data for, we are talking about 2021 data not being available for carrying out the documentation for 2021 as well. So in this scenario, even if data for 18, 19 and 19, 20 is available, I think that would sufficiently address the requirement from a compliance perspective. Of course, the additional data of 2021 would help in documenting, and then possibly will give a better scenario in terms of what's the market situation as well, specific to the year, which would of course help situations which we were discussing earlier in terms of whether a markup can be reduced or what will happen if I am in a loss situation, etc. But the other good thing is, of course, there's been the slight extension in time as well in terms of the compliance. So maybe companies can choose to wait a little longer to see how much more data that they can get for 2021, because companies' results are likely to get finalized over the next couple of months by September end or October, and then we should see a lot more data hopefully getting populated into the databases as well, and that should give a better picture as well.
And just to add one point here, Karthik, Meera, is that in situations like these where the databases are not updated or they are not giving the correct picture, it always helps to have supplementary analysis. So, for example, in cases where the company is dealing in products and they have been historically referring to the published information and trying to do an entity level benchmarking, it is highly recommended that they start doing a transactional level analysis, which is to say that they can get into analysis which is based on CUP or anything else that gives them a transactional level comparison. So supplementary analysis will not harm, it will always help. And if they don't find it supporting, they can obviously shun that, but it's always helpful.
Okay, Thanks a lot. So yeah, we're done with the questions now, and then we can move to the vote of thanks. Sumit, please.
Thank you very much, Meera. I don't know if I'm audible and visible.
Yes.
All right. Yeah, thanks a lot, everyone. I would let me rephrase it to more of a seeking feedback. Final comments from my side. Of course, I would really like to thank the entire ASA team, Sunil and Karthik, and also the team behind, which is Kim and of course the others. But Meera, I think you did mention that you are heading our very important Pune office. So those of you who are wondering, Meera Dalvi Sani is our regional director for the Pune office. And of course, you can all get to know more about the chamber by visiting our website and getting to know about all our activities. Also, talking of that, ASA incidentally has a very active YouTube and a LinkedIn profile. So I would really urge all the participants, whenever they get the time, to browse through these forums. I was recently reading something from Sunil on retrospective taxation. So they keep updating amazing new articles. So please sort of join us on LinkedIn and YouTube. And so thank you so much for joining, everyone. I think it has been quite an informative session. A lot of questions. The ones which are not answered, we'll take it back in emails. And most important date, of course, is the 24th of August at 3 o'clock for the second session of the series. And I want to make two last important points. Please send us your feedback. Because, as Sunil mentioned, probably we live in this COVID zone area for another 4 or 5 years. So we as the chamber, your feedback about the topics that you want to hear about, or it could be a simple feedback about the timing of the webinar or the day of the webinar. So please give us your feedback so that we can further improve our offerings to you. So please feel free to just go to our website and give your feedback to us so that we can keep improving. Last but not the least, in case you have not renewed your membership, I request you to please go ahead and renew your membership of the Indo-German Chamber of Commerce. I think it's not a bad idea to be a part of an organization which is celebrating 65 years in India, being the biggest chamber in the world, in terms of the activities and the members. So let us stay engaged and look forward to a continued cooperation with you. And once again, thanks to Sunil, Karthik, Meera, Fana, Hani, Manaz, and thanks most of all to all the participants. Thank you very much.
Bye.
Bye.
Thank you. Bye-bye.
Bye.